Many investors believe that diversification in your portfolio is a recipe to restrict your gains. Some investors even come out and say that diversification just flat out does not work. So I want to really spend some time today discussing diversification and why I believe it's actually important, especially during times like this that we're seeing right now with extreme volatility. And we're going to go through some real world stocks here to see how a good diversified portfolio can actually help you during these times. As always, if you enjoy this content, just hit a like down below. That's all you have to do. It's all I ask for, and I truly appreciate it. So there's many different types of diversification. You can diversify by asset type. You can diversify over time. You can diversify by industry, and there's many other ways as well that you can diversify. There's no right or wrong way to diversify, in my opinion. There's different ways that people do it. But the goal really is to have a diversified portfolio to reduce your risk in times of uncertainty. Many new investors love to gamble or invest in cheap stocks. And I don't mean cheap in the sense of PE cheap, I mean cheap in the sense of dollar value cheap. So if they see a $5 stock, they prefer investing in that over, say, a $100 stock. They may consider a stock like Uber at $25 a share cheap, but a stock like Shopify at $450 per share expensive. And this is a huge mistake, and the price per share of a stock should absolutely not play a role in determining the investment. In this example, both companies are actually very similar in size. Uber is a $45 billion company and Shopify is a $50 billion company. Share price simply does not matter when valuing companies. But anyways, getting back on track, why do we diversify? The simplest answer I could really give you is to manage risk. Investing in one company is far more riskier than investing in 10 different companies. If you only invest in one company and that company goes bankrupt, you've pretty much lost 100% of your investment. However, if you invest in 10 different companies and one of them goes bankrupt, you still have 9 other companies to make up for those losses. And really, there's no limit as to how many stocks you can diversify with. Some people choose to diversify with 10, some 20, some 30. Or some may even choose to just purchase something like the VOO, which holds the S&P 500, and those are 500 of the largest companies that you're diversifying against. So in that case, if one of those 500 companies goes bust, well, guess what? You have 499 other companies to make up for those losses and outperform over time. And the S&P 500 is actually kind of a unique diversifying method because the way it works is that when a company is not doing too well in the S&P 500, they're actually removed from that 500 list and a new company is added in. So it's constantly being added and removed to have the 500 best companies in there, which is why, in my opinion, you're never really going to go broke holding the S&P 500. But now you may be thinking, okay, Nick, so if I hold one risky stock, like say Tesla or Uber, and I go 100% in on that stock and that stock goes bankrupt, I get it, I'd lose all my money and that was a high risk play. But what if I pick a blue chip company and go 100% in on that? Isn't that pretty much a guaranteed return over the long term? Well, I would actually say this is also pretty risky. A good example of this is Boeing. Boeing has a very long-term history of being a safe, stable, and reliable investment. And up until recently, it was one of the biggest companies in the entire world, and the stock price reflected this as well. But just in a snap of a finger, things started going wrong at Boeing, and the stock dropped from a high of $450 per share to under $90 per share. And if you own the stock at $450 and this was your only investment, you would be down about 80% on your position. And again, this is with investing in a solid blue chip company. The lesson I'm trying to get across here is that no matter how safe a company may look, no matter if it's a blue chip, long-term dividend payer, doesn't really matter. Going 100% in on just one stock is risky. Now, maybe an investment like that could pay off over the long term. Maybe an investment like that may not pay off over the long term. But the point is that it's too high risk, especially for an average investor, and I personally would not be following a strategy like that. And if you're asking about me personally, I own around 32 different positions in my portfolio. If you're interested, you can check out the link description down below to the VIP group if you want to see all the stocks I own. But essentially, out of those 32 stocks, I'm pretty bullish on most of them. There's a couple of them that I may actually trim out of my portfolio here and actually sell out of. But for the most part, I like the diversity that that portfolio gives me. The stocks that I hold are all different industries, they're all different market caps, and they all have different future potential, so it gives me a very well-rounded portfolio in my opinion. And what I actually like about having a portfolio this large is that almost at any given time, whether the market's up or down, there's going to be a couple of positions in there that are providing value that I can constantly keep buying and adding to. This keeps me in the game, this keeps me interested in stocks, and this keeps me on my toes searching for value at pretty much any given point. Now, some of you may not like that. You may not want to constantly be in your portfolio and adding to positions. So in that case, maybe a portfolio of like 10 to 15 stocks would be good for you. But again, that's not financial advice. That's just something you may want to sit down and think about and actually decide on what you think is best for your situation. And I kind of touched upon another point here, which is diversifying between different industries. And this is one that's often overlooked because when I look at people, I see them diversify, but they're not really diversifying across different industries. Diversifying across different industries gives you a lot more upside in pretty much any market cycle, and you can take advantage of stocks moving higher no matter what part of the economic cycle we're in. For example, I've heard from a lot of people, yes, I'm diversified, I hold 10 different stocks, and then they start to name off the stocks. Apple, Amazon, Google, Facebook, Microsoft, and they name 5 other tech stocks. Now, yes, you're diversified between 10 different companies, but all of your companies are exposed to technology. So if something happens with the whole tech sector, maybe there's another tech bubble that bursts or something happens in the future, your portfolio is going to be down significantly and you don't have any other positions to kind of balance that out. Also, one thing I've noticed with tech is that a lot of money in a usual market where, things are just chugging along, money rotates out of technology and into financials pretty often, and then from financials back to technology, so on and so forth. So if you're holding both of those different sectors, you have a lot more balance in your portfolio over time. Now again, not everyone may agree with this. They may say, Nick, tech is the future, clearly, so why would I invest in other companies like financials, which may actually suffer over the long term? I mean, I can't really argue that because depending on what your risk tolerance is and your strategy is, it may not make sense for you. But for me personally, I like diversifying across different industries. Now, the last big way to diversify, which is the most common way that people try to diversify, is by diversifying in different assets. The most common ones that I see are either real estate or stocks. A lot of people say, you know what, I own a lot of stocks, so I'm going to go buy a REIT here to diversify myself and own some real estate. But in my opinion, owning a REIT is not really like owning real estate. A good example recently is if you look at a major REIT like O, you'll notice it had dropped hard over the last few weeks, with the rest of the stock market down over 50%. Of course, it's because of recent news and issues around in the economy, but the point is that they are still extremely volatile and lost essentially 50% of its value in a span of a month. Alternatively, if you look at actual real estate prices and home prices, you'll notice that for the most part, prices have not really moved. They are still more or less where they were, say, about a month ago. So you could still list your home for sale today and roughly get the same amount as it was a month ago. Maybe in this kind of market, it takes a bit longer to sell that home because there aren't as many buyers technically. But generally, even in recessions, you can still sell your home. Real estate prices typically lag the stock market by around 6 to 9 months, maybe even a bit more than that. So things aren't as liquid and things don't fluctuate as much. So you can still get a good return right now on your home versus if you just held a REIT like O, because right away you saw that was reflected and you were down 50% of your position in a snap of a finger. So I think that's why owning a physical piece of real estate, in my opinion, is very different from owning a REIT. And in times like this, it truly shows you the difference of owning proper real estate, actual real estate, versus just owning a stock that holds real estate. Now, you may disagree with me on this one too, but I think the numbers speak for themselves, the volatility speaks for itself, and that's kind of my stance when it comes to diversifying with assets. So this was kind of a general overview video that I really wanted to spend some time to discuss with you guys because we've had a whole bunch of new subscribers join the channel and a lot of you are brand new investors to the stock market. So I hope that you learned something from this video, and I hope that you also learned that by diversifying, sure, you may sacrifice on some gains over the long term, but you are reducing your risk significantly, and you may surprise yourself and you may actually come out better than if you just picked one stock to gamble on for the long term. Guys, thank you so much for watching. If you're brand new here, again, hit that subscribe button down below to join the community, and don't forget to drop us a like as well to support the video. But either way, thank you so much for watching, and don't forget to invest positively. Peace.